say you're planning a vacation and you want to book a flight ticket, but you're not sure about your travel plans. What would you do? Buy the ticket and pay for a rescheduling later, or wait and pay a higher price for a last-minute booking? What if you had an option to book a flight ticket at a pre-decided price for a small premium without any compulsion? Hello and welcome to a new video of the Polynomial Academy, a series where we will discuss the most important crypto trading and DeFi concepts. That last scenario of booking a flight at a small premium without any compulsion is actually possible in the financial markets through an instrument called option contracts. Options give you a choice to buy or sell an asset at a predetermined price in the future. In today's video, we are going to know more about options and share some of the most popular crypto option trading strategies. But one thing where you don't really have an option is to subscribe to this channel, because we'll keep bringing important crypto concepts for you. So make sure you do that, and now we'll get started. Options are derivative instruments that derive their value from an underlying asset like Bitcoin or stocks. They give you the choice to buy or sell Bitcoin at a pre-decided price within a specific time period. Let's assume Bitcoin is trading at $21,000 right now and you expect the price to go up but aren't really certain. You can buy a 2-month BTC option by paying a small premium of say $50. If BTC price goes up beyond $21,000, you would still be able to buy it at $21,000. But if it doesn't, you're not obligated to buy it either. The only cost in that case will be the $50 of premium that you paid. Now there are two types of options contracts: call options and put options. Calls let you buy an asset at the strike price, while puts allow you to sell them at that price. Options can be used for speculating on price movements, hedging positions, and earning premiums. Now that you know what options are, let's look at some of the most useful option strategies for crypto trading. First, let's talk about straddles. Let's assume Ethereum is about to undergo an upgrade, but you aren't certain about what that might mean for the price of Ethereum. In this situation, you would use the straddle strategy, which allows buying both a call and a put option with the same strike price and the term. You buy a call and a put option with a $1,500 strike price, both expiring in a month from today, at a total premium of $100, which is $50 for the call and $50 for the put. This strategy protects you no matter where the ETH price goes. If ETH surges to $1,800 after the upgrade, you can still buy it at $1,500 for your call option. When you factor the premium cost, you can still acquire the token for only $1,550 compared to its current price of $1,800, thus resulting in a profit of $250. But even if ETH price drops to $1,200, you can sell it for $1,500 by exercising your put option, resulting in a $250 profit after accounting for the $50 premium. However, if ETH's price remains unchanged, neither of your options may be exercised, and you would end up losing the entire $100 paid in premiums. Next up, we have strangles. Strangles involve buying both a call and a put option of the same asset, similar to that of a straddle, but with different strike prices in this case. This strategy is useful when you anticipate a significant price movement in the underlying asset. We use different strike prices for both options to create a wider profit range, but which also implies that the asset will need to move more significantly. The call option typically has a strike price above the current market price, while the put option has a strike price below the current market price. Let's consider the same example with ETH currently trading at $1,500. You purchase a call option at a strike price of $1,600 and a put option at a strike price of $1,400, both expiring in a month with a total premium of $80, $40 for each option. If ETH price rises to $1,800, the call option becomes profitable, resulting in a net profit of $260 after accounting for the $40 premium. But if ETH price drops to $1,200, the put option becomes profitable, thus resulting in a net profit of again $260 per token after deducting the $40 premium. And lastly, the Iron Condor. The Iron Condor strategy aims to profit from a stable asset by selling call and put options with the strike prices outside the expected range and buying options with an even further strike prices. For instance, if Bitcoin is trading at $30,000 and is expected to remain stable, you can sell a $32,000 call and a $28,000 put, collecting premiums on both. As a part of this strategy, you also need to purchase a $33,000 call and a $27,000 put. Now, if the BTC price remains within this range defined by the strike prices of the sold options, namely $28,000 and $32,000, you will profit from the premiums received. However, if the price moves significantly beyond this defined range, you will begin to incur losses, although these losses will be limited by the call and put options you purchase. The iron condor strategy is ideal for generating income from options premium during sideways price trends, while also managing risks in case of unexpected price swings. Option strategies are one of the most popular trading techniques used by even experienced traders, and I'm confident that now you also can start exploring the world of options. But there's a lot more to learn about options and other important aspects of crypto trading, and we are building this Polynomial Academy series to help you learn about all of them. So subscribe and press that bell icon to avoid missing out on other useful videos. I'll see you in the next one.